Hello, everyone. Happy Friday. My name is Denver Noah's president of Wealth for Life. Today, we're doing our Modern Family Dynasty newsletter recap. And I'm going to talk about how lucky I am to be spending $250,000 for health insurance. And I'm going to kind of break that down. So we do this every week. We go through the newsletter and just do kind of a recap. So if you're not subscribed to that, you can jump onto LinkedIn. The Modern Family Dynasty newsletter is there. Or you can go to the website wealthforlife.net, subscribe via email. But each week, I'm sharing tips on how to grow and protect your wealth, kind of a lot of the stuff that is outside of conventional wisdom. So we're going to jump right in today onto what we're talking about, health insurance premiums. And recently, in kind of doing my taxes, I was kind of looking at the premiums and stuff that I pay. I'm self-employed, right? And so my current premiums are around $1,527 a month, family of four. Wife, two young kids. So adds up to about $18,327 per year. Then I saw a post from Graham Stephan on Twitter, which I'll show in just a second. And the inflation rate, 297%, is what health insurance has been up over the last 25 years or so. And when I just extrapolated that inflation rate out and added it to what my premiums are, and how they have been going up, you can see there from the chart, 18,000, 19,000, 21,000, 23 over the next 10 years, which is, at least how long my kids will be on my plan. $265,495 in health insurance premium, which is actually pretty crazy. And I'm depressed that I actually added that up and looked at that number. And that doesn't include what we actually have to pay out of pocket, because we're on a high deductible plan. We have like an $8,000 family out of pocket. So like this last year, we had, my son had an injury from sports and, $20,000, $30,000 in bills, but we still had to pay our, $4,000 to $5,000 deductible. My wife has a small issue, we pay another $3,000 there. So like we're hitting these out of pocket numbers. But then on top of that, we're still going to pay the $265,000 in premium over the next 10 years. So then, of course, you think about what could I do with that money if I was able to invest it and grow it. And of course, there's not any other good options right now. When you start looking at it, I have to have medical coverage, as you're self-employed, and you look at kind of this chart right here, where, let me switch that, where this is the chart that Graham had shared, where this is the cost of health insurance premiums and what's happened to those over the last, 25 years. And I don't see any end in sight in this type of inflation, but you can see in 1999, 5,700 all the way up to, 22,000 beyond average. So maybe I should be happy I'm paying a little less than average, but that's primarily because we have more of a high deductible plan. And then, as he points out here too, and you look at, United Healthcare and what they've been able to, the profits, up 7,000% in, since the year 2000. And nobody has any issue with profits, but what's happening right now in the system that we have is that, you have subsidies, right? If you're self-employed or you can't get coverage through your employer, you go to healthcare.gov, and then you can get almost all of or usually all of your health insurance premium covered. So, but those subsidies end at about $110,000 per year for a family. And so that's something that I kind of always talk about. Like right now, and from previous episodes, you probably know the top 10% of Americans pay 70% of all federal taxes. And that's probably income, 100,000, 100 or so and up, getting in the top 10%. So now here again, we go to health insurance and you get into the top 10%, and all of a sudden you don't get any subsidies for your health insurance premiums. So now you're paying that full rate. And in the whole system, as people are getting to be more successful, not trying to go from top 10% to top 1%, you're getting the full force of the entire system. You're getting, those people get hit with the highest tax rates, and they're getting hit with, hey, we don't get any subsidies, we're paying full rate on premium. And so then on the health insurance side, what incentives do these insurance companies have to keep costs in control when the government's going to pay premiums for 90% of the population? And they don't have really the incentives to be more profitable because it's just they're getting the check from the government, they're getting reimbursed. So obviously, I don't think that there's kind of a short fix to that system. And then I point out in there in the episode, there was an interview with Mark Cuban and the guys from Anderson, A15, and they kind of point out there's a lot of misincentives. There's a lot of people that want the system to stay the way it is, and there's probably no really quick answer to change that. And so as a self-employed individual, which is the same answer I have for a lot of problems. A lot of time, our best defense is just to raise our income, protect our wealth from taxes, keep growing our businesses. And that approach, I think, applies to a lot of conventional problems that not just the people in the top 10% have, but everyone has. I know there's kind of those two schools of thought, the Dave Ramsey's of the world, where you just have to cut expenses and kind of live on top ramen, which there's nothing wrong with getting rid of frivolous debts, but a lot of times it's easier and more effective to grow your wealth and make more money. So I think that is absolutely what the case when it comes to health insurance premiums. And if you check out the post from Graham Stephan on Twitter, it's actually a great thread and goes through some of the issues. And it's hopefully, I don't know, does it help that we're able to raise more awareness? I don't know. It was eye-opening for me to actually see that I'm going to pay over $250,000 for health insurance. So it's just, okay, what am I going to focus on? Growing my businesses, making more revenue, protecting my wealth from taxes, right? So that should be our first line of defense there. So then I know I went out of order in this section of the newsletter. In the newsletter, there's always 4 sections where we have the learn section, the chart section, productivity, and the concept. That was the chart section. And now I'm going to jump back to the learn section. And this has to deal with what is one of the biggest risks of retirement, and even that you need to think about before you get to retirement. But one of the biggest risks is when you start withdrawing money and what's happening at the market at that time. And so this chart really lays it out well. And it just shows if you have your $500,000 account, you start withdrawing in 1998, everything's pretty good. You get 25 years of income out of it, 23 years of income. But if you start withdrawing just 2 years later, in the year 2000, 2 years, simple 2 years, it cuts the income in half, like the amount of time it has. It goes from 23 years down to 11 or 12 years, and you're out of money. And that difference of just 2 years is because when you start is because of just a couple of market losses early on when you start taking out money. And people really underestimate the impact of that. And being a planner and having sat down with people and mapped out income and then had things not go right when they were starting to, hey, we're going to take income, and now it's a couple of years ago, markets are having some big drawdowns. It really throws off the numbers more than people think. And especially when, the common mainstream advice is, you know what, you just got to buy an index fund and let that thing run and everything's going to be fine. Not the case. And again, when you have a time and runway for markets to recover, yeah, that's great. But eventually those things have to be turned on to income. And if you start getting into a cycle where the markets aren't doing what you want them to do, where the markets are getting anemic, where bonds are losing money, where stocks are losing money, and you're having to withdraw, this is the difference. Money would have lasted 23 years, then it all of a sudden only lasts 11 years. So this type of stuff is easily mitigated by getting outside of mainstream financial advice, which tells you to just kind of keep everything in the stock market and using other income streams. And this is something that, of course, we'll be talking about, but I wanted to share a quick case study of what it looks like to kind of start building in alternative assets and assets that aren't just related to the stock market. So the idea here is you're building income streams. So no matter what's happening in the world, you have money coming in. That way, if you're taking out money, markets are down, you don't have to pull money out of those markets accounts, and you're not going to compound your losses. And that will allow the markets to recover. So that's the idea behind income streams that aren't related. But the key is you want to be setting these up a long time before you get to retirement, because sometimes it can take 10 years to build up stable income streams that aren't related, whether using real estate, businesses, or like this is a strategy from a business owner that I work with. We're using a SEP plan. It's a SEP IRA, and he's contributing to it. And right now, with rates as high as they are, a lot of this comes down to being able to evaluate the entire investment world and cherry pick products that are going to give you the best rates and best returns. And those change based on different conditions. That's why when you're working with a team, they should not be captive to any one particular strategy. Meaning you don't want someone that's captive to stocks or bonds, because that's just one asset. And there's a lot of other ways to do it. In this example, with rates where they're at 19% matching on all deposits for 7 years. So as you can see, he's contributing to add his $50,000 a year, but he's getting guaranteed interest levels coming in and building income stream now that is not related to what happens in the stocks or bonds market. So there's a lot of other assets like that are out there. You just have to be able to, work with teams that think outside the box. But the idea is going away from just this area of stocks and bonds where you really don't have any control. We have no control over what the market's going to do. Even the best people on this planet, cannot predict what the market's going to do a year from now. We've seen both stocks fall and bonds fall. A lot of issues there. Again, this is not anti-stock. I mean, I'm an investment advisor. We use those plans, but I recognize, in having done planning with high net worth people for 20 years, that most of the wealth the high net worth make is not in the stock market. It comes from the stock market from other places. And then when they're building income streams, stocks and bonds are usually one of their smallest allocations. So you're going from this era of stocks and bonds where you don't have control over to offense and defense, different types of assets, offensive assets, defensive assets, setting those up so no matter what's happening in the world, you have money coming in. That gives you control. So again, it's going from no control to control, and control is how you really build financial security. So I will be going into more detail on that in the upcoming event that we have. This is the 5 secret strategies millionaires use to cut taxes and 5x their wealth, part 3. Last 2 events have been incredible. We had over 1,200 people at those events. You can sign up at 5xevent.com. This will be on LinkedIn, so it'll be a LinkedIn Live. You can ask questions and chat and do all that cool stuff on LinkedIn. So make sure you check out that event. And now kind of quickly going through the newsletter, the next productivity hack I have is just the BIOS lights. I love lighting. We put different lighting in our house. And what it does is it kind of syncs more with your circadian rhythms. So if you're trying to get better sleep, lighting is a huge deal. And these particular lights, I love these. We've replaced almost all the lights in the house with that. And we have the 2 kids and everything. So what happens is during the day, you make them brighter, more of a natural lighting, so it keeps you nice and alert. But then as the day goes on, and certainly as it gets to sunset, you start ambering these things down. And it's a specially designed science and amber frequencies that they use to make that light come down, gives you more of a natural lighting in the house, helps everyone kind of wind down. And I definitely think it affects in my sleep, gives me better sleep. And it's nice. It adds a really cool ambiance. The bulbs are easy. You just, put them in your cam lights in your ceiling, and they're dimmable, and you just manually do it throughout the day. So I love those. They work great. That's my productivity tip for the week. And then lastly, talking about the concept. And this kind of goes into a little bit of, what we've been talking about earlier with income mapping and things like that, which we will cover in the event. But it's this idea of what mainstream advice has kind of structured for people, where you're going to build up wealth and then it's going to decline. And, that's the normal method. You're just trying to design your wealth so you don't run out of money. The modern family dynasty model is always outside of conventional wisdom. How do we continue to have our wealth grow? How do we continue to have it accelerate so that it can last for generations? And that is super important, building the modern family dynasty. It's not easy to get into the top 10%. It's harder to get in the top 1%. Once you get there, you should be able to stay there and keep your generations there, not giving anyone a free ride, of course, but setting up the system so that your values and beliefs that you have to create success can continue for multiple generations. That's really true legacy. That's the idea of building, going from mainstream advice to the modern family dynasty. And we do talk about this a lot in the LinkedIn group. So this is a private group for my high net worth clients where we come in. I'm always pulling ideas from what I'm learning from all my high net worth clients, sharing those in the group. And, we have resource folders and videos and other things that I can't post publicly because a lot of these strategies, again, people go to the wealthy, do different things. They absolutely do. So there's certain strategies that are a little more tightly held. So we put some of those information in the group. So if you haven't joined, make sure you go to wealthforlifegroup.com. That will redirect you right to LinkedIn, and you can sign up there, and I'll get a message from you as well. So that's wealthforlifegroup.com. And actually, that's it. That's our recap for this week. If you have any questions, please reach out. My name is Denver Noahs. Thank you for all the great feedback I get. I'm glad people enjoy the newsletter. And if you have topics you'd like to see, please let me know, and I will include some of those in the newsletter. Thanks again.